Good morning, everyone. Welcome and thank you for joining our webinar today. This is Jyoti here, and we are very happy to have you here with us today. In today's webinar, along with Sudhir Pai, we have with us Anup Nayak from My Time Equity and Rajiv Venkatesh from My Tax Filer. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management RIA firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through the disclosure slide that our attorneys mandate that we show prior to every webinar. If you have any questions, during the presentation, please feel free to type them in the Q&A box and we will have them at the end during the Q&A session. If you need Sudhir's help, please write to wealth@mytimeequity.com or call us on 972-330-2771. Over to you, Sudhir.
Thank you, Jyoti, and very good morning, folks. Thanks for joining today's webinar. The title of today's webinar is Momentum Really Dead? Why is this title chosen? Because we saw a very long red candle last week, and it was caused because of panic, which has been created because of continuous tariff discussions that are going on in the Oval Office and changes of date, for execution of and implementation of the tariff on Canada, Mexico, Europe, and China. It was supposed to be postponed till April 4th, but looks like it is going to be preponed to March 3rd, and that caused a significant sell-off, in the equity markets and crypto markets, last week. So the momentum has come under a little bit of pressure as well because the consumer sentiment fell, and that caused the momentum stocks to take a bigger beating, while the value stocks did okay. So it was not red all across all sectors of S&P 500. Real estate did okay, healthcare did very well, consumer staples did extremely well, utilities was okay, technology took bigger beating, Nasdaq took bigger beating. As you can see, Nasdaq was down 3.47%, and Bitcoin went as low as 84,000, on Friday. So we expect further, sideways movement in the coming week. Also, the seasonality of February has played out over the last 2 years. The seasonality, which means the data that we take from 1950 till date, we call it the seasonal data. We look at the average of all those years, and for a year where the new administration has taken over, new president has taken over, the seasonality data shows that February second half is usually a red 2 weeks, and it did pan out as per the seasonality. So we expect sideways movement as the seasonality charts. I will show you that chart in a short while. But that's what I'm expecting, next week to be a little better week. But with the conversation that I think you all witnessed in the Oval Office, with President Trump and President Zelensky and Vice President Vance, the discussion didn't go well, and I think the results of that will be seen in the coming weeks. Looks like the entire European region is supporting Zelensky, while Trump is kind of showed the support to Putin and Europe without really giving them any assurance. So I went into a little bit of a spiral, and that may have some impact next week. So we have to see how the week goes, but I'm expecting a sideways movement and some more correction taking place in Bitcoin, because we expect the Bitcoin to go between 64 and 72, which is the previous lows. We think that it can touch those levels and then start shooting upwards. Our expectation for Bitcoin this year is about $130,000. The all-time high so far has been around 108. So, we are still positive about the equity markets, the commodities market, the crypto market, but coming weeks is going to be a little bit of cautious move, for the markets. Next slide, Jyoti. Okay, so this particular slide shows you, the individual members. This is a survey that takes place every week. So this shows you, how many bulls are there in the market for those weeks and how many bears. If you see the number of bears, the percentage of bears have gone up, which means people who are concerned with the stock market falling further, all the shorting that is taking place, because of which, you see the bears percentage has increased to almost 60. So what this says usually is, if the percentage of bears has gone up to that percentage in the past, we see a significant growth in the coming months. So, while these numbers look very worrisome as of today, please keep in mind that stock market does not go down all the time. 80% of the time it goes up, and 20% of the time it comes down. And anything that goes up has to come down. So we are seeing that correction right now, and this correction has not been a huge correction or anything like that. And as I said, coming week we expect a sideways consolidation taking place, unless and until there is some new information that is going to be causing more panic than what happened last week. Next. So this chart shows you the consolidation and the seasonal pattern, which I am been talking about. Look at the first half, the month of February. It went up and then it went down, and then a sideward movement, and then April onwards the spike up all the way up to December, and with some correction coming, consolidation happening between October and November. So this is the seasonal chart, and we hope that the trend continues to be like this, and overall, we see double-digit return for S&P 500 for 2025. Next. So the earnings, right? Most of the companies have announced their earnings for Q4 of 2024. The earnings number have been extremely good. The expectation on the top line was around 4%. It has come out around, if you remove energy out of all the sectors, it should be around 6%. And on the earnings side, which is the net income, if you remove energy out of the mix, it's around 17%. So the expectation is around 9 to 14%. So the numbers that have been announced by all the 400 plus companies, there are about another 78 companies, I think, yet to come out with their earnings. But otherwise, most of the large companies have declared their earnings, and the numbers are extremely good. But the CEOs, 40% of the CEOs are giving not such great guidance for the rest of 2025, just because they are very uncertain about what is happening, in US right now, with the tariff war going on, reciprocal tariff being discussed on all countries, and with all the unemployment that is being caused because of DOGE, the Department of Governmental Efficiency. There has been weaker guidance for 2025, and that is where the momentum is coming under a little bit of threat. So market thrives on momentum. People keep buying because they think the market is going to do well because earnings is good, unemployment numbers are not bad, inflation numbers are in control. So overall, the everything was positive until all this day-to-day noise that tries to bring short-term corrections in the equity markets. So overall, if you see, the earnings are good. Market seems to be in a good bullish trend, except for a few weeks of February, and let's see how March goes. Next slide. These are the GDP numbers. We expected GDP numbers to be in line, or of around 2%. So that's around 2.3%. So even the GDP numbers are pretty good. So all this tells you that, we as economy, we are very strong. Next. So what's going to happen next week, right? We have the manufacturing PMI numbers and the services PMI numbers coming out on Wednesday. And on Friday, we have the unemployment numbers, the non-farm payroll numbers and the ADP numbers. So all of these are very important, indicators of how the economy is doing. If you look at the manufacturing PMI, over the last 26 months, we have not seen this kind of number. So it has been very encouraging, the manufacturing PMI, which clearly shows that there is industrialization starting in America. And with all these news about Trump gold card of putting in $5 million, inviting rich industrialists to America and having their company started here, and reduction of tariff for such companies, I think in the long run, whatever President Trump is doing is going to bring in industrialization back, because we saw a lot of outsourcing of manufacturing happen to China in 1970s and 80s. And now I think that reversal may happen slowly. Nothing can happen overnight. It has to be slow and steady. So we have seen this manufacturing PMI do better last month. It crossed 50 last month. This time the expectation is around 51. So let's see how it goes on Monday, which is day after tomorrow. And on Wednesday we have the services PMI, which means US thrives on services, right? Less manufacturing, more services from the last 20 years. So even that, the forecast is about 52.7. So let's see how that goes. If these two numbers come out well, I think we'll see very good week. And last but not the least, on Friday, we have the unemployment numbers and ADP numbers coming on Thursday. So if this shows, as per consensus and forecast, I think next week should be good. But keep in mind, geopolitical tensions can always create enough pressure and panic selling amongst investors, because last 2 years we have seen a lot of returns, almost 45% over 2 years. So there will be a lot of investors who would want to take some chips off the table. That panic mode is on right now. We are still not at extreme fear. We are in the closer to extreme fear, but I think when that happens, I think usually people start buying the dip and markets start turning green. Next. So very quick look at our models. On the second slide, the three models that you see, custom IBKR, custom Schwab, and margin. Those are our models where most of our clients are invested. Those are all ETF models. We have individual stock models as well. If you see, in those models, the small cap has done very well, and the techno optics have done very well. All weather portfolio year to date has beaten the S&P 500. China has beaten the S&P 500 like crazy. The technology index of China has been really doing well. If you look on the left side, the international markets are doing very well. The international model that we have at MT has done extremely well, because Europe, as it is at its all-time high, China technology is doing extremely well, and there are other countries like Poland and Indonesia and Philippines, and some of these emerging countries are doing very well. Not India. India has been on the downward trend, but and we are not in India in our international model. So we are purely in other countries where the forecast has been forecast is good, and the growth so far has been great. And there is some value in those countries, like China, for example. It has been down from last 2 years, 3 years, and that is where we have some exposure to international markets within our three custom models, which is custom IBKR, Schwab, and margin. So we are doing well on the ETF models as well as individual stock model. Overall, this is what is the representation of our model. Next slide, Jyoti. Okay, coming to structured notes, we have a few structured notes, and if you have any questions on these, I think most of you already know some of these structures, but there are new notes that we have launched, end of last week. So this particular note is an income note, income note on three stocks, which is AMD, Palantir, and Micron. This note actually ends on March 14th, so you have 14 more days. So if you invest in this, you get $1,875 per month. If you are investing, $100,000, so you make 22.5% or 1.8% per month. And the way this works is, it's a note that has been issued by Barclays Bank, one of the top banks within the banking line of banking line that we have. And this is a 3-year note with a 6-month callable option, which means the bank can return the money back to you within 6 months, provided all these three stocks are positive. And if they are not positive, at the end of 6 months, the note will not be called, means the money will not be returned, and it continues for 3 years. and every month you keep getting paid as long as one or more of the stocks have not gone below 50% in value from the March 14th price. So on March 14th, this note will record the price of these three stocks. And at the end of 1 year, at the end of 6 months, they see if the price of any of the stocks is lower. If it's not, it goes till third year. At the end of 3 years, if the price of none of these stocks have fallen below 50, you get your money back. So this is for someone who is looking to earn monthly income. These incomes are taxed as regular income, and the return that you get on a monthly basis is 1.8%, or annualized return is 22.5%. So if you have money sitting in your checking account, or you kept it in a bank in a CD for 4%, 5%, this might be a better place to invest because the returns, the yields are extremely high. And all the three companies that we have chosen are extremely great companies, and they're all part of the index. And we also have included a feature in this called memory, which you can see in the last box of the first the flyer. So memory feature means, in any particular month, let's say Palantir 2 months from now falls below 50%, and the monthly payment stops. Now what happens when Palantir comes back to more than 50%? Then you get paid for all those months that you missed the payment. And it's a 3-year note with a 6 months call. So this can get a little confusing. So if you have questions, please type it in the questions box, and we can take your questions at the end. So this is one note that we have, which will end in 14 days. So time is of the essence. So talk to us if you are interested in earning this 1.8% per month or 22.5% per year. Next slide, Jyoti. So this is the second note which we have currently open. This note ends on March 21st, 2025. And this note is called as a snowball note. And this note is on the futures index of S&P 500. So everyone knows S&P 500 as an index, 500 top companies of large cap companies of America. There is an index called the futures index, which means, when the markets are closed, there is a futures market that will be open. And we have selected that index with a 35% volatility, meaning, higher volatility is higher risk and higher return. So we have selected 35% volatility. S&P usually has a 20% volatility. So we have taken a little bit higher volatility because we want to get a slightly higher return. This particular index and this particular note gives you a 25% return per year, and it's a 5-year note. You can liquidate it anytime you want, but we suggest not to enter into this note if you are not looking for long-term investment, because liquidity options, while they are there, it will not get you the best result if you try to cancel this, in middle of the term. The way this works is, this is a callable note, which means the bank can return the money back to you at the end of year one. Between month 1 and month 12, there is no action to be taken. At the end of year one, if this index is flat or positive, you get 25% and your money back. And if it is more than 25%, if this index is more than 25%, which has happened multiple times during the year, you get the higher return. So it's either 25% or it is the higher return which you will make at the end of year one. Now, if the note is down at the end of year one, then the note goes to year two. And at the end of year two, again, if the note is positive or flat, you get 50% or the return from this particular index. And this index is, you can Google for this index. You can see the results of this index online. This index was created by JP Morgan Chase, and a very well-known index. But what we have done here is we have taken that index instead of S&P 500, purely because, this index gives us a higher return. But we have put a 50% downside protection. So, you are kind of protected. That way, your money is not going to lose its value if this index does not go below 50% at the end of fifth year. So for it to go down at the end of fifth year, there has to be some significant, news that may happen in the world, right? Like World War III, or some major growth scare or major growth, this whole AI thing. If it's a hype, it's all a bubble. If it drops from today's price, the price of March 21st, 2025, at the end of fifth year, it should fall below 50% of that price. So you can see, right, we have put a lot of risk mitigation in place with this note. And the returns, go to the next slide, Jyoti. If you look at the returns of this particular index, which we'll show you in the next slide, um, only in 2 years, in 2008, the financial crisis, and 2022, the bear markets, we saw the index fall between 40 and 50%. So we have a 50% downside protection. And if you look on the green side, the index has gone to 91%, in 2020, 2017, while the S&P 500, which is the last column, generated 19%. So this index has the tendency to get very high return or very high risk, but the risk is captured with the downside protection, and the return we will get if we are lucky enough to get higher return. If the return is not higher than 25, anyways you make 25%. So the note snowballs every year. So it's 25, 50, 75, 100, 125. That is how it keeps snowballing. So which means you have an assured return of 25% per year, provided the note does not go below 50% from the price of March 21st, 2025. Little confusing because it has a lot of parameters which we have included to reduce the risk. So the chances of losing money is remote. Next slide, Jyoti. Jyoti, next slide. Okay. So this is one other note we have launched. It's an income note. This note has 20%. You may ask the question, why should I invest in this when you have the other note which is 22.5? Again, diversification is the name of the game. And here the stocks, if you look at the names of stocks, it is Amazon, Nvidia, and Microsoft. All the three companies are part of Magnificent Four, not seven, but four. And this note was made at a special request of one of our client. And we are presenting this to you also because we can take other clients' money as well. So this note generates a 20% income. This is issued by Bank of Montreal, and it's a 3-year term with a 3-month call, which means in 3 months the bank can return the money if all the three stocks are positive at the end of 3 months. And the downside protection, you have 40% on the principal and the coupon, and you make 1.6% per month or 20% per year. The trade date of this is not has been finalized. We should be getting the final date on Monday, and we are trying to get a date of March 11th as the date for this note, because these three stocks are extremely in demand stocks and extremely strong companies. Nvidia particularly, the results were good and the guidance was good. So it's a note that we got created for this particular client for a very large amount of money that he's investing. So we are planning to offer this to our clients as well. Now, all these notes you can invest in it if you have a Charles Schwab account, and we can help you open one in case you don't have one. Or if you are already a client of MyTime Equity, all you have to do is deposit additional money, and we can trade this. We can place a trade for this particular note, one or all three, on the respective dates. Next slide, Jyoti. Okay, so that ends my presentation, and we have Rajiv Venkatesh Kaniyar from MyTaxFiler here today to answer questions and also to take the clients of MyTime Equity over some of the tax deadlines, tax planning ideas, and the tax filing for 2024. So Rajiv will take over from here, and if you have any questions, please post it in the questions box on all the slides that I presented so far. Also on the tax questions, if you may have any. Raju, over to you.
Yeah, thank you so much, Sudhir. And good morning, everyone. Thanks for joining us today, for taking time on the weekend on this Saturday. So coming to the tax planning or the tax topics, we go through the agenda of filing due dates, residency status, what are the deductions and credits, what are the difference between these, what are foreign disclosure and international compliances that's going to happen, repatriation of the funds either from a US person, foreign person, what happens with the gifts, and finally the very hot topic is the tax planning. So uh, of driving down deep into of these topics, as Sudhir mentioned, my name is Rajiv Kanyar Venkatesh. I'm working with My Tax Filer. I'm one of the senior tax manager. So just a short background on myself. I'm one of the enrolled agents there, and in case if you need any help in filing your tax returns, feel free to contact us. So let's jumpstart with our tax topics. The first is the filing due dates. So we are in mid of the tax season. We are in the 2025 filing season for the 2024 tax year, and there are various forms and various deadlines for each of these forms. So Form 1040 that we file, which is the individuals and the corporations. This is a corporation as a business entity. For both of these, 15th April is the tax deadline. For pass-through entities, or it's also called as a corp or partnership or a multi-member LLCs, March 17th is the tax deadline, being that March 15th is a weekend. So, you are getting a bonus 2 days, or rather we are getting bonus 2 days. Form 1099 filing, it's the due date has already passed. What is Form 1099? Just like how we get a W2, the contractors will get a 1099. So if you are a contractor or if you are a business owner, you have to issue a 1099 to the contractor. So we can help you in filing the contractor forms or 1099 forms in case if you have one or if you have not filed it yet. Extended tax deadlines for all of these will give an additional 6 months time. Be it be like Form 1040 and corporations, 15th April will shift to October 15th. For S corps and partnership, it will shift to September 15th. So for non-profits, again, it's May 15th, and with the extension, it is again 6 months with the November 15th. So next slide, Jyoti. So next is the residency status and the tax treatment. So in particular, individuals like us, there are only two things that can happen. Either it can be a resident or a non-resident. So who are residents? People who are US citizens are considered to be a permanent residents or green cards, which are popularly called, or tax residents. Tax residents are the people who, as simple as they stay 183 full days in the US soil. When I say full days, it is as it means that they have to be in the US soil. Anyone who is traveling on the international waters, it's not considered to be full days. So any person who satisfies either it's a citizen, US citizen, green card, or a tax resident satisfying 183 days, they are considered to be a residents of the United States. And for them, all the worldwide income is taxable. Either it is a US tax home or a foreign tax home. What's the key difference is, if there is a US tax home, you will file a form 1040 including all your worldwide income. Of course, if there are any tax paid in the foreign country, you will get the credit for whatever tax is paid in the foreign country. However, note that the country in which you generated the income has a first right to tax that income. So you have to file the tax returns of that country, and later you have to claim the credit in US. So when the tax home is a foreign country, likewise the worldwide income is taxable, but the key difference is there is something called as a foreign earned income exclusion. This has come out with the Internal Revenue Code 2555. So, or it's called as Section 911 exclusion. So with this, there is a chance of uh, excluding around $126,500 of income from your active incomes, and you pay the taxes for rest of the income. So the tax rate will still remain the same, either it's a US tax home or a foreign tax home. However, the foreign earned income exclusion limit applies if there is a foreign tax home. There are a lot of caveats associated with it. There are a lot of tests. One has to qualify for that with that test to qualify for this income exclusion. Okay, so we talked about the residents. What about non-residents? Non-residents, as simple as if they don't qualify as a resident, they are non-resident. So in that there are two categories: either you have a US source income or a foreign source income. Let's say someone comes from the US, come from foreign country to the US on a visitor visa. While they are here, they were earning some income in their foreign country. So is it subject to US tax? No, it's not, because they are here for a visitor or for a purpose of business or a pleasure tourism, and the country in which their home country, and they're generating the income, there is no taxes in the US because you stayed here. However, if you are in US for a temporary, and if you are here for a business purpose and you generated income, so then there is a non-resident form that needs to be filed, and the tax rate applies. And in case if it's not connected to business, let's say it's either like a dividend, interest, capital gains, or we can call it as a non-passive, or sorry, passive income, then generally it will be treated at the tax rate of 30%, or in case if there is a tax treaty between that particular country, the taxes will be done at that particular tax treaty rate. Yeah. So next slide. So next is the deductions and the credit. So there is a difference between what is a deduction and what is a credit. So deduction is something which reduces your income, whereas credits is something which reduces your taxes. So it's a credit is dollar to dollar reduction. Let's say you owe to pay $10,000 and someone gives a credit of $1,000, which means you are paying taxes instead of 10,000. You have a $1,000 credit. You are paying taxes of 9,000. However, how deduction works? Someone is giving a deduction of 1,000 for a 10,000 income. You are going to deduct $1,000 from your income of 10,000. You are paying the taxes at $9,000. So credit, it reduces the tax dollar by dollar. However, deduction, it reduces the taxable income to arrive at the tax number. So there are a lot of deductions and credits. It depends on the income tax brackets, and it depends on the income levels in which a individual or a taxpayer lies at, and based on that, the deductions and credits are applicable. Though there are variety of deductions, a few popular deductions are the standard deduction. The standard deduction for multiple filing statuses, the IRS has issued the standard deduction numbers. And note that these standard deduction numbers, it keeps increasing every year based on the inflation. So for 2024, for joint filing status, this is going to be like $29,200, and for single, it's it's half of 29,200. And there is something called as an itemized deduction for people who have more taxes paid, or more interest paid on their home loans. There are a lot of charity or donations done, lot of medical expenses. So there is another sort of deduction called as an itemized deduction. An individual can choose between standard deduction or itemized deduction, but not both. So whichever is eligible or whichever is beneficial for a taxpayer, he can go with either a standard deduction or a itemized deduction. So coming to HSA or a FSA, HSA is health savings account, and FSA is flexible spending account. You can open the HSA account and keep spending for the medical purposes, in case if you have co-pays to be paid, or you have to go to CVS for buying some of the meds or whatnot, right? So you can, instead of using your credit cards, buy with a HSA card or a FSA card. so that whatever you spend will be a tax deduction at you. Even if you are saving like anything more than $1 you save, it's it's something you saved, right? Instead you pay with credit card, unless your credit card gives you more points than this, then it makes sense in saving. But I'm sure that we will be mostly at least more than 10%. So I think that you are saving the tax for at least more than 10% of now what you have been paying. Instead, your credit card is giving you a cashback of like 3% or 4%. So you are saving you are getting almost 150% more benefit. This is the other way to think of it. So student loan interest deduction, uh, you know again it is subject to income tax limits. However, you can take a deduction of $2,500 per student. 401k contribution limit, this is up to 23,000, and with a catch-up contribution of 3,500. What is catch-up contribution? It is just that it is called as additional contribution for the folks who are aged 50 or above. The tax or a technical terminology is called as a catch-up contribution. So IRA contribution limit, it is 7,000 for under 50, and over 50 it's 8,000. Simple contribution retirement accounts, and that's 16,000. And foreign earned income exclusion, as I said in the previous slide, it's around 126,500. This is all about deductions. What about the credits? Credit, each child, if you are in an income range within the permissible income ranges, and if you have a child or a couple of children, uh, you are entitled to get $2,000 for each child as a child tax credit. And as said, this credit will reduce your taxes, not your taxable income. Other dependent credit, if you have a dependent parent or a brother, sister, who's staying with you, you are supporting to them for more than 50% in your residence, you can claim them as your dependent in your tax returns, and there you are eligible for getting $500 as a dependent care credit. So electric vehicle credit, it's also revamped, or it's now called as a clean vehicle energy credit. So for new vehicle, it's around $7,500, and for used vehicles, it's around $4,000. With the new, with the new president, and there are a lot of talks going on with the non-electric mandate. There were also talks where the credits are going away, but because being Dodge in place, and Mr. Musk is in charge. Uh, we don't know. It's highly doubtful that he may create some sort of a spark with the president to maintain this credit, because it benefits a lot of people. So residential clean energy credit, if you do any energy upgrades to your home, it's not only about your home, it's also for your investment properties. If you do any residential energy upgrades, like save energy, or like going for a green energy, upgrading your windows, doors, putting a storm door, uh, and ventilated windows. So all those, it is up. It was almost up earlier it was like 10%. Now it is 30%. Earlier, when I say up to 2022 it was 10%, and from 2023 it has become to 30%. So you can take the benefit of this until 2032. So earned income credit, this is a credit for the people who are for the low income groups. Mostly we have to see the qualifications for these, and have to see who is eligible. Maybe in case if any student or any US citizen, he is fighting on his own, struggling to support for himself, with no other support from the parents. Maybe you can see if he qualifies on these earned income credit criteria. Lifetime learning credit is something it's one of the education credits other than an American opportunity credit that I'll talk in the next slide. Lifetime learning credit, as the name itself says, it is applicable for anyone, and there is no cap for who can take this. However, there are income restrictions for this, but if you want to enroll in some sort of a course in a college and you want to take this course, you can get the benefit of lifetime learning credit. This has to be enrolled with a college, but it's not necessary that you need to be a full-time student of the college. You can still do the courses or the studies in the part-time, and you can still be eligible for this credit. However, income limit still applies for this. The credit is $2,000 per return or per person. So American Opportunity Credit, this is one of the famous tax credits, mostly the for the people who are undergrads. They will take the eligibility for this, or people, you can do some sort of a tax planning where if you are sending your kids to the college and they are in the summer job, they are trying to make money for themselves, and they are supporting themselves with not much of a support to you. We can try to see, by filing a separate tax return for them and take the option or eligibility. You can see if they can get a benefit of claiming the American Opportunity Tax Credit in their tax return. So qualified adoption credit, this is something related to adoption. With a qualified adoption, you are getting a credit of around $16,000. Okay. So next slide. So the next is foreign disclosures. So this is key area in one of the international engagements, considering that most of our clients have ties with US, India, or any other foreign countries. Uh, Mostly they are maybe in different countries, traveling job, and they would have had assets in various countries, bank accounts, right? So this is not new. There's something called as FBAR. This is being managed. This is not part of IRS for your information. This is part of a FinCEN. What is FinCEN? FinCEN is called as Financial Crimes and Enforcement. This is a separate agency that's been managed. It's mainly for the money laundering or a lot of other things that happens. This agency is taking care of all those. So there's one of the powerful agencies that's available. So FBAR is foreign bank account reporting. When it says bank, it doesn't literally mean that it's only the bank. So foreign bank account reporting, what it means is, if you have financial assets and financial accounts. When I say financial accounts, it is bank, or you may have like PPF, EPF, savings bank account, CDs. In other countries, they call it as a fixed deposit or a national pension scheme or whatever, right? So any sort of financial bank accounts and financial assets, I mean, as like stocks, shares, insurance policies, mutual funds. So all these are financial assets. You having financial assets or accounts, and the value of these assets and accounts in totaling any time of the year, if it crosses $10,000, you have to file this FBAR form. So this form is nothing to do with the tax returns. It doesn't attract with any taxes. As the name itself says, it is foreign bank account reporting. So it is just a report that needs to be submitted. If you are submitting year on year, it's well and good. In case if you are not submitting, it is better to go complex. So there are as said, this is not new. This was introduced in 1970s as part of a Banking Security Act. It is applicable for individuals, businesses, and the form use is FinCEN 4114. So there are intergovernmental agreements, we call it as IGAs, between US and of course India and many other countries. In that IGAs, IRS has the authority to ask anyone from any country, any bank, they can pull out the data for US tax residents. So it's better to be late than sorry, right? So in case if you feel that you are compliant, be continue to be compliant. In case if you are hearing this for the first time, maybe we can help you out in filing the compliance things and settle it out. So there's one more thing called as FATCA. So okay, so I'll talk about FATCA in the next one, but uh, you know how do we come out of this? Uh, if you are not compliant. So there is a separate program called as a streamline filing procedure that is there in the next slide. So we can see what can be done. We'll review your tax returns and see, is it considered to be have you marked somewhere that you are aware of this or you're not aware of this. We will thoroughly check that, and we will guide you in case if it's eligible for you to file the complaint. Okay, so coming about FATCA. FATCA is called as Foreign Account Tax Compliance Act. So what it means is, you would be knowingly or you would be unknowingly checking a checkbox in whenever you are doing any online transaction. So what it means, that checkbox, what it means is you are agreeing to disclose your information to any government agencies within the US. So that's what the checkbox means. Maybe next time when you log into your internet banking accounts of a foreign country, when there is a slight check mark, just go through those details, fine lines. You will see something which is mentioned as Foreign Account Tax Compliance Act or FATCA, something in those lines you can see. So again, this doesn't have any tax implications, but in case if you don't file, the implications will be huge. So there are particular, just like the FBAR, how it's a standard threshold of $10,000. For FATCA, there's a threshold of in case if you are living within the US, there's a threshold of 150,000 as a highest balance and year-end balance at 100, reduced to half for single filing status. Because if you are living outside US, 600,000 year-end, sorry, 600,000 highest, year-end 400, and reduced to half for single and separate. So penalties, it can include, as long as if it is a non-willful violation, penalty may be imposed but not exceed 10,000. But willful violation, it can be up to 100,000 or 50% of the balance, or there can be a criminal prosecution as well. So as said, in case if you are compliant, please continue to be so. In case not, maybe you can contact us for more details for the specifics to talk. Okay, next slide, Jyoti. So what if non-compliant? So this is what we are talking about, something called as a streamlined filing procedure. There was something called as a OVDP, called as Offshore Voluntary Disclosure Program, that was initiated in 2010 and it went up to 2014 with the various names changes. Once it's called as OVDI, and later it was calling as OVDP. So and later, because of at those times there was a IRS examiners, they were trying to come, they were trying to audit with all the bank statements line by line. Even I have seen few cases where they were inquiring about even 100 rupees of details where this transaction went. That much detail they were asking. But Of course, if that was ended in 2014, and later the streamlined filing or the FBAR filing people, that they sort of, it was like an eye opener to them at that time. And now streamlined filing, it's more of a uh, not so as complicated as OVDP or OVDI, but it's still complicated with the streamlined filing procedures. There will not be any examinations going on. There will not be any closing agreements. We haven't seen any civil penalties or examinations that's happened once the once there is a uh, good faith that the clients have or the taxpayers have submitted the report. In this, the pitfalls is there is a 5% penalty on the balances, on the higher CRN balances. What is to do is you have to amend all your 3-year tax returns and file 6 years of FBAR. So in addition, in case if you have mutual funds in a foreign country, there can be a special forums called as a it's called as a passive foreign investment company, and there can be a special forums that has to be filed called as Form 8621. And in case if you are a owner in a foreign partnership or a corporation of exceeding at least 10% and above in corporation, 25% and above in your partnerships, there are additional forms needs to be filed. Any gifts given away, if you as a US resident has given away the gifts more than the annual exclusion limit of $19,000 per person, you may have to file a gift tax return for this. And in case if you have a foreign ownership, maybe you have to in a disregarded or a single member a sole proprietorship entity, you have to file Form 8850. In addition to this, there is something called as a BOIR. It's a new forum, it's a new uh, law that has come. So what is BOIR? It's called as Beneficial Ownership Information Reporting. This is also mainly in talk. This is the hot topic nowadays, what's going on. FinCEN announced to file the BOIR for all the business owners, let it be a single member, multi-member, LLC, S Corp, C Corp, whichever entity you have, right? Other than sole proprietorship, where you have not incorporated in any state level. They want the owner's information, their identity information to be reported. So they are creating a robust system, and all with all those systems, and due to money laundering things to curb the activities, they have created the you know some sort of a platform where all the business owners has to comply. So there is estimated that a penalty of $571 can be an estimated penalty each day. So there are a lot of discussions. FinCEN announced one judge, one court, federal court, they put a ban again. They lifted the ban. There are couple of times the ban lifted, and as of today, as of yesterday, the news was March 21st was the final deadline to file this. And as of today, the deadline is that the ban is lifted. However, uh, the taxpayers, the business owners may continue to file it. It's as tax professionals, what we recommend is to file it, be compliant, because as of now they have said there is no examination, there is no penalties, there is no enforcements, but we don't know when they will come and with what pace they will come. So reach out to your tax professionals or contact us in case if you need help in filing these returns. So next slide is the wealth transfers, US person to US person, US person to foreign, or foreign to foreign. Each will have a specific limit. US to US person, you can transfer asset around $90,000 per recipient per donor. US person to foreign person, there is certainly not much of a limit here, but the same limit applies for foreign person to US. You can receive the gift of up to $100,000. It's tax free. However, there are certain forms that needs to be filed if it's exceeding. The whatever the gifts you donate, all will be in a lifetime exclusion limit of 13.99 million, which is increased from 13.6 million from 24. And any funds that has to be repatriated from a foreign country, anyway, US doesn't have a limit of incoming funds. However, you have to comply with the banking regulations of the foreign country. So what are the tax planning tips? So start with your paychecks with proper withholding. We have often seen people coming at the last minute and saying that why have to pay so much tax? That's because one, you have not withholding your uh, taxes from your paychecks in the right manner. See, for everyone, it's either for you or for me, for anyone. The tax brackets are the same. It's just that you have not properly checked the tax withholdings that's happening from your W4 or from your paychecks every month versus you get a large pay as a monthly payment. However, you will pay a bigger sum at the year end. So instead, wise decision is to start the paychecks with the proper withholding. Paying the estimated taxes penalty, in case if you are not withholding properly, there is chances that the estimated tax penalty also shoots up. It's up to 8% now. When we are not getting the interest of 8%, when we have to pay to the IRS of up to 8%, right? So paying the estimated taxes properly, even in case if there is a short withholding, and that makes a better idea to avoid. So tax check ahead, don't wait for the end of the year. It's better to reach out to your tax professionals and see where is your position is. Is it in your refund due or you have to pay any estimated taxes? It is always good to get a refund, avoid interest payments, or rather paying the taxes to the IRS, because you don't just pay the taxes, you will also pay a penalty for it. Penalty in terms of interest. So there is no point in paying. Enroll in 401k or upon retirement plan. It is a tax saving dollar. What you save now, you're saving the tax dollars now, and you are paying when you are at a retirement age. So at your retirement age, your tax rate may be less. What you are earning now may not be same as when you are earning in your 60s or 70s, right? So, and also with the inflation, the standard deduction in numbers increase, the dollar value will decrease, the time value of money. Considering all those, putting the money into 401k will save a lot of money for you. So considering the 529 plans, though there is no federal tax deduction for this, however, state tax deduction applies if you are a resident of the state where there is a state plan eligibility is available. HSA, which is health savings account, we already talked about it. Capital loss harvesting, if you are having an underlying stocks which is not performing versus super performing stocks, and you have a hefty tax bill to pay, instead of paying hefty tax bill, selling underperforming stocks and then letting it off always makes sense, right? So plan your business and putting into action, creating LLCs, maybe converting yourself from a W to a contractor, and you taking care of your company with the accelerated amount of deductions, buying business vehicles, or even contributing a higher amount to the 401ks, profit sharing, all those will help. Planning your dependent care expenses, when there are dependent care should be taken, you can do that also. Cost aggregation study, we can do the cost seg study in case if you have multiple properties and there is something that there is a lot of accelerated depreciation can be taken for it. So 1031 exchange referrals and section 121 exclusions, even these things related to real estate tax investments, Opportunity zone investment, in case if you have a capital gains, you can always defer the taxes by investing in this opportunity zone investments. Depreciation is buying a business asset and taking a depreciation here. Cost study is also one of the accelerated way of depreciation. Investing in tax saving strategies, there are a lot of tax saving strategies available, and however, you can consult us in case if you need to see what study will help what. Okay, so I'm over and above 1 minute. So thank you so much, and thanks for the opportunity. Yeah, over to you, Jyoti.
Thank you, Rajiv. Now we have few questions. Anup will take the question. Over to you, Anup.
Yeah, thanks, Jyoti. You're able to hear me, right? Yeah.
Yes, we are
Okay.
able to.
So the first question is on AMD and Palantir note, which has high PE ratios compared to their peers. With the stock market showing bearish trend, this can reduce the cushion barrier 50% significantly. What are your thoughts on the structured notes? It's a good question. So for this particular structured notes, we have also designed in such a way that it is a long-term structured notes, 3 years in this case, and relatively a good protection barrier. Normally it comes with about 40% protection barrier, but this comes with a 50% protection barrier. And most importantly, the memory feature is the one that is the USP of this particular note. So these are the three factors that we have considered to mitigate the risk that was talked now. Okay. Now the second question that we have got, again on the same note, a bank can call the note after 6 months if anyone's price is not below the price on March 14th, or the price not below 50% of the price from March 14th. That is the first question, and I'll answer this first. So the fundamentals is very simple. Typically, when they call anywhere from 6 months to the 35th month, which is 1 month, less than 3 years, then their objective is to give the money back, and of course, with whatever monthly income that they have received. So in this case, the parameter would be as long as all the stock prices are above 50% of the initial traded value, that is when the bank might call after the 6 months. The second question is, let us just say that for the first 6 months the prices let us say the first 6 months the prices of one of the stocks is below 50%, so we don't get any coupon. But after 6 months, let's say the least performing stock goes above 50% from the March 14th levels, will they give all 6 months or 7 months coupon? And of the note. In other words, if the note is called before 3 years, we should get coupons for all previous months. Is this understanding right? Yeah, that is right. So with the memory feature, however months the income is not paid, moment all the stock prices are above the 50% of the traded value on March 14th, you will get your the income for all those months that you have lost. And secondly, as I mentioned earlier, if it is called between 6 months and 35 months, you will get your principal and all the income because of the memory features. I see that these are the two questions that I had, and Rajiv, there was one question for you. I'll read it out for you. If I happen to receive an unexpected investment return in December, what is the impact on estimated tax penalty, since there is no time to withhold due to unexpected sales in the last month of fiscal year?
Okay, so the question is, if happen to receive an unexpected investment return, so which means that they are getting the income, some sort of unexpected income to them. So how it affects is maybe in case if they are getting an income and if they are not paying the taxes, that income gets added to their taxes as an income, and overall their tax returns, if let's say if he was owing $10,000 without this income, and if he owes now $20,000, right, because of this unexpected income, for the remaining $20,000, he would have to pay the estimated tax penalty. So how to avoid this is as soon as income is received, irrespective there is a withholding or a non-withholding, you know what is your tax bracket is it. So a simple math is, let's say now you received $10,000 as an unexpected income, and assume you are at a tax rate of 10%. That's for our simple analysis. 10,000, you should have paid $1,000 as a tax. Now what's happening? Uh, you know, you are sure that there is no taxes being withheld, or so you have to pay $1,000 taxes, but there's no withholding. So go to IRS website, IRS Direct, IRS Direct Pay, click on estimated taxes and pay $1,000 for the quarter in which you have received. Let's say in December they received, then the ending date of that quarter to pay estimated taxes is Jan 15th. So they can just go pay the whatever the taxes that they owe, and they can get rid of the estimated tax penalty.
Thanks, Rajiv. I think those were the three questions that we have got. I don't see any other questions over here. I think with that, we are good to conclude this webinar. Thank you all. Have a nice rest of the weekend.
Thank you, Anup. So thanks for joining our webinar today. If you have any questions, you can please write to wealth@mytimeequity.com, or you can feel free to call us on 972-330 and 2771. Thank you and have a great weekend. Thank you all. Bye-bye.
Thanks, Jyoti. Thanks, Jyoti. Bye.
Yeah, bye-bye. Thanks, Rajiv.